I think it'll be interesting to see how Chair Powell characterizes that as we get to the press conference on Wednesday. Specifically, how he's characterizing that growth versus inflation balance and how he views, I think, the path that we've seen in inflation throughout the course of Q1. Was it a matter of mostly a hot January that's later cooled into February and March, or is this more of an upswing that we're seeing? And I think that really factors into how they view their dot plot. So we're also listening to see how Chair Powell characterizes his view towards the last dot plot, which had 3 cuts within that. We think he could push back a little bit on that, and it'll be really interesting to see how he characterizes the Fed's next move. Do they view sticky inflation as a matter of staying higher for longer, or does it put the threat of rate hikes on the table? But I think when we look at the environment, we do think that 1 rate cut this year looks quite reasonable.
Let's just get into the time frame a bit more, because after we had that data last week, the PCE increasing 2.7%, some are saying, look, we've now hit a pause pattern for the Fed while they debate whether this is a bump on the road. If it is a bump on the road and was just a hot start to the year, when do we start to potentially get better data, cooler data on the inflation side?
I think we need to, bring it down into the drivers of inflation. So when we look at it, what's supply driven or really what's core goods, ultimately that looks like more of the stable bucket of inflation. You could see some of that deflation starting to peter out a little bit. Where the Fed is really focused, I think, is one on the shelter dynamics and on the labor market dynamics. On the shelter dynamics, we continue to see a lot of promise from leading indicators, and we think that momentum will continue, especially into the back half of this year. And when it comes to the labor market, I think what the Fed really wants to be sure of is that the labor market is not retightening, that we continue to see that natural rebalancing from that labor supply coming back online. And so when it comes to timing, I think it's very much a second half story and probably more towards the tail end of the year.
Yeah, that's fascinating. Madison, I'm wondering if, despite all the jawboning coming from me and every other financial media commentator and from your industry as well, actually we're all looking in the wrong place, because interest rates is one important factor, but it's not the be-all and end-all for the earnings. And actually the earnings is the amalgam of every input that's coming in. The cost of money is just one input as well. The earnings season looks solid. Future earnings expectations look really solid. Are we looking in the wrong place? The market and me especially, I held my hand up. I've been obsessed by where the Fed's going to be, where the ECB, the Bank of England. But actually, is it the earnings season we need to spend way more focus on for the future trajectory of these markets?
I think that's really fair. I think, over the course of the past year and a half, we've been very honed in on this macro debate, but incrementally, and especially as we've seen in this earnings season and the last one, I think it becomes much more of a micro story where we can talk a lot about this really, I think, healthy momentum that we're seeing from companies. A lot of that has to do with the idea that we've seen, corrections across a number of sectors within the market already, and we're really now just at the beginning stages of that earnings growth really coming to fruition and starting to accelerate. So this looks to be just the 3rd straight quarter of earnings growth for the S&P 500, probably going to be around 3% year over year for the quarter, but we think that the full year will be north of 10%, and that would be the best full year of earnings growth since 2021.